Okay, hi guys. Welcome to workshop number 2. First off, thank you everyone for coming today. So we'll be receiving live questions at this link over here. So I'll just give you some time to take down the link or scan the QR code. Okay. So just a bit about DSC SOC. We currently have over 750 DSC chapters. So it's across, it's worldwide. So in US, Canada, Europe, like Africa, Middle East as well. And what we do is we build like a community of learning through empathy and curiosity by advocating a growth mindset. And most importantly, to engage and impact communities. So some of the activities that we are planning to conduct or have conducted, the Hack-for-Good hackathon, Tech-for-Good workshops like the one you are attending right now, and occasionally we have industry talks where we invite professionals to connect with people who are interested in hearing them out. All right. So if you guys haven't followed us, here's our social media channels, and the QR code is over here. So this is just a snapshot of our team. And yeah, without further ado, I'll start on our presentation. So today I'll be covering technical analysis and algorithmic trading. So previously if you guys attended workshop 1, the finance and analytics one, we covered the basic asset classes, so equities, forex, fixed income, and like even real estate. And we also covered fundamental analysis and how to use the Python API to retrieve financial data. So today the focus will be on equities, so just equities, and we'll be using I'll be sharing with you guys how we can use technical analysis to better decide when to go in and out of the trades. So I'll cover firstly an introduction to the most common technical indicators used in the industry, and how they are calculated and how we can use them. Followed by how we can implement some of these technical indicators into actual real-life algorithms, where we can actually sort of implement and then backtest. So that will be the second part, right? And yeah, so basically, if you guys don't know what technical analysis is, it's one of the two main analysis tools when it comes to financial instruments. The first being FA, fundamental analysis. Then technical analysis is basically, it seeks to predict sort of price movements by examining historical data, mainly price and volume. So whenever you talk about technical analysis, it's normally the indicators that you're seeing. So sometimes they might have really weird and unique names, right? But usually it usually either tracks price or it tracks volume. So these technical indicators form what we call as trading signals. So they are used to inform trading decisions when to go in and out of the trade. Yeah, so I'll be elaborating on that later. So this is just a summary of the difference between technical analysis and fundamental analysis. So the definition is that so basically I think this table is quite self-explanatory. Basically, for fundamental analysis, the main difference is that we are using we are looking on a more longer term position, often holding for like weeks or even months. But for technical analysis, it's more used to determine when to go in a trade on an intraday or even intra-week basis. So So today I'll be discussing the 5 most common technical indicators. So we have relative strength index, moving averages, Bollinger Bands, OBV, and the average directional index. So firstly, RSI, right? RSI is basically the relative strength index. And we usually use an arbitrary period for this. So it's usually 14 days, and the value ranges from 0 to 100. So basically what the relative strength index measures is it measures how overbought or oversold the stock is. So this is a formula for the RSI. Honestly, you don't have to manually calculate it because most websites and computer programs that sort of provide this kind of backtesting software to implement your algorithms, they normally have built-in indicators. So normally you don't have to calculate, but it's good if you sort of it's a good start to give you a better understanding of sort of how the formulas are derived. So basically, it sums up the RS sums up the average gain for the past X number of days, usually 14 days, versus the average loss, and then you just plug it into the RSI formula. And of course, if the value is higher, tending towards 100, then it means that the stock is more overbought. It means it's probably not a good time to go in. It's probably a good time to sell out. And conversely, if it's close to zero, then it's pretty much very oversold, and it will be a good time to go in. Of course, you gotta look at other factors as well, like whether it's a company you're comfortable holding and whatnot. And the second is moving averages. So moving averages is represented as an X-day moving average. So there are two kinds of moving averages. The first is a simple moving average, and the second is an exponential moving average. So the difference is that the exponential moving average gives more weight to recent price movements, and that's really the main difference. There's no other difference. But essentially, what the moving average does is that it basically, in layman terms, it basically just gives you a numerical figure for the average price for the particular financial instrument you're checking. So the most common time periods for EMA is 8, 21, 34, 55, and 89. So all these are sort of conventions. So you normally just follow, okay? So for SMA, it's 50, 100, and 200. So this moving average formula I think it's quite self-explanatory. Basically, you have the past, let's say you want to find a moving average for the past 50 days, you just take the C1 all the way to C50, the price 1 all the way to price 50, and then over 50. So that basically gives you a SMA. For EMA, you basically just add in this multiplier and this time periods plus 1, and then you'll just get some figure which you then plug into the formula. Once again, most computer programs have built-in indicators to help you sort of get these indicators out, so you don't have to worry about it. And yeah, basically a derivation from the moving average is called as a technical indicator. It's called the MACD, which I'll be showing later. It's basically moving average, convergence, divergence, and it's commonly used to determine the entry point for buying or selling into stocks. So the idea is that we use two different EMA, so one longer and one shorter. So the longer one, there'll be a lag, right? So the idea is that the lag between the longer moving average can be used as an indicator that the trend is resuming upwards. So when the longer EMA, let's say 21, let's say the 8 EMA crosses the 21 EMA, because the 8 EMA is it reflects the more recent price movements, right? And 21 EMA there's a lag. So basically this is a bullish reversal sign. And conversely, when a shorter EMA crosses when it goes down the longer EMA, it's a bearish reversal sign. Okay. So this is basically just a snapshot on TradingView. So this is basically the one in red is the 21 EMA, and then basically these are basically how you would normally use your EMAs, and basically the green and the red line, the one in the middle is basically your price. The candle bars are basically your price, and the line in the middle is your 21 EMA, and then the respective color lines are basically all your other common EMA periods that are shown just now. So normally a bullish reversal sign would be when the EMAs are stacked. So basically what that means is that when the EMAs are stacked, it means that let's say you're looking for a bullish stack. So basically what that means is that the shorter EMA period will be more than all the longer EMA periods. So the 8 will be more than 21, and the 21 will be more than the 34 and then 55, then and 89. So that's like, it's a very good scenario to go into the stock lah. Okay, so and then the third one is Bollinger Bands. So Bollinger Bands is it's quite a simple concept actually. It's basically just plotting a trend line, plus minus usually 2 or 3 standard deviations away from the SMA or the EMA. And we usually use a 21-day EMA for this. So as you can see in this sort of snip from TradingView, so the candle bars are the price, and then the middle line is the 21 EMA, and the upper and the lower line is basically the plus minus 2 standard deviation. So a good example of a trading strategy is maybe you think like if the price goes below the -2 standard deviation, means it's a good time to buy. So you can eyeball the chart and you see, hey, actually, yeah, it sounds like a good idea. Like most of the times when it actually goes below the -2 standard deviation, you there's a tendency to sort of get a decent profit, at least in the past 6 months. And then the fourth indicator is on OBV. So this is a volume indicator. So it's basically an indicator of momentum, which uses volume changes to make price predictions. So the theory is based on the distinction between sort of smart money, institutional investors, versus your day-to-day retail investors like us. So the whole idea behind it is that volume precedes price, and that the divergence between the OBV and price are used as a leading indicator. So a bullish divergence forms when the OBV moves higher or forms a higher low, even as prices move lower or forge a lower low. Yeah, so and then conversely, it's bearish when OBV moves lower or forms a lower low, even as prices move higher or forge a Oh, sorry, I did. Yeah, so basically the OBV calculation is this. So if today's closing price is higher than yesterday's closing price, then the current OBV equals to previous OBV plus today's volume. And if today's closing price is lower than yesterday's closing price, then the current OBV equals to previous OBV minus today's volume. And then lastly, if today's closing price equals yesterday's closing price, then the OBV is equals to the previous OBV. And once again, you don't have to worry because like most of these indicators are built into most of the platforms. And the last indicator is average directional index. So this is usually used as an add-on to determine the strength of the trend. So in one of the algorithms later, I'll be showing you guys how we can incorporate the ADX into one of the trading algorithms. So basically, this basically just illustrates like the strength of a trend in terms of like volume and price. So it's usually represented by two lines: the red line, which is a negative directional index, and the green line, which is a positive directional index. So when the red line is above the green line, it means that the price is dropping. And then we look at the magnitude, maybe it's like 40, means that it's dropping quite significantly and the trend is quite strong. And vice versa, when the green line is above the red line, it means that the price is rising. So with that, I'll move on to algorithmic trading. So I'm sure you guys will have heard of like these like the buzzword algo trading and whatnot, like around the finance industry. But basically, it's algorithmic trading is very simple. It's really just using technical indicators as trading signals to determine when to buy and sell across a broad range of time periods. So some people might be really high frequency traders, and they use like a sort of a second data. So they trade like so their trade periods in less than a minute. Some people might be more longer term, so they trade like their holding periods are like a few hours or maybe even of 1 or 2 weeks. It really determines on the strategy. It really determines on your sort of your big picture strategy that you are trying to use. But essentially, you are using trading indicators as signals, usually as lagging signals to cue the algorithm into entering and exiting the trade. And hold on. Okay, give me a minute, guys. Okay, sorry guys. Yeah, so basically, resuming from algorithmic trading, we basically eyeball the technical chart to see if previous trades were worked out. So we look at platforms like TradingView and TC2000. And yeah, so basically, like what I mentioned just now, you eyeball your technical charts to see if previous trades were worked out following your algorithm you're using. So like for example, this one, I want to use like a simple RSI strategy, like in this case, a 3-day RSI. So what I will do is maybe I have an idea in mind. I want to go in a trade when the RSI dips below like a certain value. So maybe like it dips below 15, which is like below in this green bar. Now then what I will do is I'll look back maybe 6 months or a year, and I'll see how the trade will have turned out. So in this case, I look at here, and then I see here, this is when I would probably get in, right? And then when it hits like in this red zone, which is above 85, then I'll sell out. So this would have been a profitable trade. Then you look at the next few ones as well, and you see it actually most of the times it turns out into a positive trade. So it might be a good trading idea for this instrument. So the methodology for creating algorithms is that firstly, we come up with a big picture idea. So for example, like what I just mentioned, wanting to buy when the RSI is low and the price is at the lower Bollinger Band, and then we eyeball the chart on TradingView or platform of your choice. And then secondly, we codify this idea into the algorithm by coming up with hard numbers to test. So these hard numbers are basically your backtesting numbers. These are basically just historical data, which you'll see later. And then thirdly, we backtest the strategy by running it on historical data, preferably for at least 5 years. And then we optimize the hard numbers, which includes like the stop losses, your indicator threshold values. And then we usually do it by working backwards. And yeah, I mean, you'll see it later. So now I'll be walking you guys through like a Jupyter notebook. So what I'll be doing is I'll be using the Python API to retrieve Yahoo Finance data. And I'll be illustrating how we can use like an MACD trading strategy to sort of implement this algorithm and then backtest it. So you guys should have this notebook. And basically if you don't know how to use it, basically you should just shift enter to run. So shift enter. Basically just over here I'm just importing all the necessary libraries. And then here is basically just the main functions, other functions that are defined for later use. And then this one is I'm basically just specifying the start date and the end date for the backtest. And I don't know if I clarified it just now, but basically backtesting is basically testing your algorithm on historical price data and seeing how it would seeing how, the returns it would produce and then comparing it to the benchmark. So that's basically what backtesting is. So this is the start date and the time date for the backtest. And then over here, we are downloading the Yahoo Finance data using the pandas data reader function. And then over here, we are retrieving the historical data. And then this is like a sample output. And then over here, we are building the main data frames. And then here, we are dropping the sort of unnecessary columns, basically just keeping the columns that we need for this entire backtest. So the algorithm actually, the bulk of the algorithm actually starts here. So over here we are actually using the 26-12 EMA crossover. So it's a MACD strategy, and basically the mid length is 26 and the shorter length is 12. So you'll see in a chart later. So basically this is I randomly picked a stock. I just picked the first one on the list. So it's ABT. It's Airport Micro. So basically the look at the EMA, right? The 26 is always lagging the 12. So one strategy is that if the 12 sort of crosses below the 26, means there is a bearish trend. So usually what you will do is that you will try to short sell or you'll sell out of your position. And short selling is basically done when you are bearish on a particular stock. So what is short selling is basically going out to your broker and let's say for this stock ABT, and telling your broker like, hey, I'm a bit bearish on this stock, but in exchange, right, I would like to borrow some shares of ABT and then sell it at the current price, so that if your bearish sort of convictions come true, then come 1, 2, 3 months down the road, you can buy it back at a lower price and then return it to your broker. So that way you make a profit. It's basically like the reverse of the traditional buy and sell. So this is basically this is where the algorithm actually starts. So the greater than is just a very simple function. And then the backtest is basically so this is a strategy that sort of is very simple. It's really just to let you guys see how it's actually implemented if we were to hard code it. Usually people don't hard code it. They use like platforms like Quantconnect or Quantopian to implement the algorithms. So if you look at this, the backtest MA, so these are your parameters, and then basically this is your start date, end date. I'm getting it from the main DF data frames, and then I'm assuming you actually buy in on the first day, and then the starting cash position is 100, and then these are the short sold price and the current stock price, right? And then because I assume you buy in on the first day, so I actually start holding closer through and buying closer forms, and then I just run for I in range from the start date to the end date, which is defined over here. I basically if the short sold price is more than 0, then I append it to the first array. So this array is basically just a basket of all the prices. It's to keep track. It's to keep track of the historical prices. But basically the strategy comes here. So this is where the MACD sort of composite indicator comes from. And basically when the strategy is that when the 12-day EMA dips below the 26 EMA, then you'll start selling. Yeah, so without further ado, right, I'll just run the algorithm. So this is, it's very hard for me to, you must go and eyeball it yourself. It's very hard for me to sort of explain like how this algorithm works deep down, because there are too many days to sort of go in. Basically, I'm backtesting over a period of 10 years, and essentially, the whole idea is that it's basically just the EMA crossover. So this is how you implement it, and if you guys are interested, you can use this as a template. So the final output is actually just the cash plus the stock holdings. So this is actually our final sort of what we have ended up with, which is not too bad. At least it's in positive territory as compared to like the 100 we started out with. So yeah, that is basically how you would sort of hard code the entire algorithmic trading process if you were not using anything at all, like any kind of software or like a website or platform, which is not often the case, which is also not recommended, because you have to use, when you look at this, right, you have to go and define your own indicator. Let's say the EMA, SMA, you have to go and go and find out the formula, then you got to go and like hard code the math inside. And then this takes up a lot of time, if you do it on a daily basis, it takes up a lot of time. So usually people use a wide variety of backtesting websites or software. So they range from Quantconnect, Quantopian, MT4, as well as TradingView. So all these platforms have backtesting websites and software. So basically, today I'll be sharing with you guys Quantconnect. Basically, Quantconnect is a backtesting website for equities, forex, and options, and it provides access to paper and live trading as well. So it provides all the backtesting facilities, and it computes various metrics like your Sharpe ratio, which has been covered in a previous workshop, and portfolio drawdown and all that. It helps you basically evaluate your whole algorithm. So yeah, I'll be walking you guys through like the Quantconnect UI. Okay, so this is so I'll be showing you guys a simple RSI algorithm. So essentially, if you guys see just now, right? So one of the algorithms I sort of had in mind was that basically when the RSI dips below a certain value, right? And the price dips where's the slide? Yeah, so basically one of the strategies is that when the RSI dips below a certain value, I will illustrate it here. So if you look here, this is a live trading chart of Tesla's the 6 months. So basically when so if you look at here, so basically my strategy is that when the RSI dips below, let's say 12, then I'll start to buy in. And if you zoom in, you say, hey, actually here is below 12, then I'll start to buy in, purchase more into the stock, right? And then I'll sell out when it reaches like the rate zone, which is above 85. And then you see that, hey, actually it is profitable. And then you go to the next ones, and then you see, and you compare. Okay, so in this case, this one over here is a neutral trade. It's not that profitable. And then you look at the next one, which is this one. It's a profitable trade, and then you basically just eyeball the chart. You see whether the strategy will work. So as long as it works like more than 60% of the time, it usually is a pretty good strategy already. So essentially, same thing. Basically, you'll notice a lot of similarities between this backtest and the one on Quantconnect, because it essentially is always the same. So you set a start date, you set your initial cash position, and then you set the ticker you want to buy, and then a benchmark that you are benchmarking your entire trading strategy against. So most people, they benchmark against SPY or the NASDAQ. So NASDAQ is QQQ. So it's up to you. So usually if it's a sort of tech-based kind of stock, you usually benchmark to the NASDAQ. And if it's just like a regular normal stock, right, you benchmark it to the SPY. So yeah, so okay, so one more thing is that so basically, if you look at all this, right, this is basically where I define my indicators. So this is like, so the first one is the one I'm using, it's RSI. So in this case, I'm using a 3-period RSI, and I'm using a daily resolution. And then basically, all these are indicators that I've tried to sort of incorporate into the algorithm as well, but it didn't improve the results. So I omitted it as a result. But basically, these are the counter channels, and like this is the average return and this SMA. So I think you can just go to documentation. You can just go to documentation. You can see all like the indicators here for the Quantconnect platform, if you guys are interested. So there are a lot of indicators, but honestly, like the 5 that I showed you guys just now, they are the most used ones. So so on to the main part of the algorithm. So essentially, the first thing I do is that I get the closing price for that day. So it's basically updating the price to the closing price for that day itself. And then if self.holdings is more than or equals to 0, basically I'm not holding anything in my portfolio, and the RSI indicator is ready, and the RSI is below 12, means is a good time to buy in. Then I will create a stock market order to buy in at a particular price at the price of in this case is 0 point usually at a fixed price. So usually set a limit order around like maybe 97% of the current price, and then you set the holdings to this basically just like indicating that you have bought the stock, and then you set the holdings to 1. And then conversely, when you want to sell out is when you actually are holding the stock and the RSI is above 85. So that's when you dump the stock and then you liquidate everything in your portfolio. So this is like the simplest of strategies that you can implement on this platform. So, and then essentially over here, what we're doing is we're just updating the benchmark value and we are plotting it alongside the main strategy that we are implementing there. So in this case, the benchmark is the SPY, and we're just for whatever sort of portfolio value that we are seeing, we plot it against like the price of the SPY as a function of time. So I'll backtest it. Okay, so as you guys see, right, the candle bars are actually the results of the portfolio that we tried to implement. So this is basically the SPY from 2012 to 2021 has yielded around has gone from 100K to 352, and our algorithm on this strategy has improved that to 732,000. So that would be considered a good algorithm because it beats your market indexes, and in this case we will say it generates alpha. So over here you can look at compounding annual returns. So in this case, the average loss is negative 5.44% and a total of 718 trades. You can see like the report gives you like the orders gives you like the trades. But really there's no point monitoring all this. But basically, if you look at the drawdown, then the drawdown is basically what is the maximum like peak to trough loss in terms of like portfolio value, and then your net profit is basically just your net profit over your initial value, and then your compounding annual return, which is probably the most important one, is basically your how much you earn on an annual basis, and it's basically compounded So 24.467% is actually very good annual returns. So this is a potential strategy you can consider. And the second strategy is actually the second strategy that I want to share with you guys is actually a sort of a passive trading strategy. So this one is more of a, it's also used in the industry when it comes to algo trading, but not used as much or not as sort of publicized because it's passive, and like people are usually not interested in these kind of things. What usually people hear is that, hey, this guy buy into like he implemented some short-term trading algorithm, and he buys in and like every day, and he bought like 1,000% or something like that. So usually these are the stories that make the headlines and not these kind of passive trading strategies. But these strategies do still have a place in the algo trading space. So essentially what I'm doing here is the same thing. So we're setting the start date and we're setting the end date. And then we're also setting the initial cash value to be 100K. And the whole idea behind this strategy is that it's an ETF passive rebalancing strategy. So what I do is that I buy into the triple NASDAQ, I buy into the 20-year treasury, and I buy into the triple small cap, which is TNA, and then I put it in my basket. So by doing this, I already achieved diversification. So that ensures that I have my bases covered, and my strategy is safer because the ETF is a basket of stock indexes. And then I set my same thing like what I did just now. I set the init benchmark to the SPY, and then this is basically just the main algorithm itself. Basically, I'm rebalancing every 3 weeks, and I initialize it to trigger at the first week. And then this is just a Boolean flag chase. And this is just a scheduler that in a Quantconnect platform. And basically, this is just a strategy. So every 3 weeks, they'll rebalance in accordance to these ratios. So triple NASDAQ is 60%, 20-year treasury is 30%, and triple small cap is 30%. And then this will update the benchmark value and plot it against the SPY as usual. So if you guys so you'll see that the results from this passive trading strategy is actually really good, and it's actually one of the so it's actually done really well compared to sort of your run-of-the-mill sort of your SPY lah. So you can see the outperformance is actually really quite a lot lah. Definitely a trading strategy you definitely can consider, even though it's passive. And it's basically like more than 10 times sort of returns. And even in periods where sort of the SPY goes down, you don't actually say going below the SPY. It means that in all periods, the portfolio value is actually always beating the market. So this is actually a very good trading strategy. If you look at the average loss is actually just negative 0.26%, and the drawdown is 65%, but that's quite common for most sort of portfolios. And the CAGR is 43.525%, which is very high. So that's compared to the SPY. So SPY's CAGR is over the past 10 years, it's been around 10%. So that's actually 43.525% is actually quite good. And with that, I move on to like the last strategy. So this is a Bollinger Band plus ADX strategy so basically this strategy, right? Like what I briefed you guys just now, right? Basically what we are trying to do is when the ADX and the red line is below the green line, it means that the price is dropping up. So the strategy is built upon the whole idea of Bollinger Bands. So basically, if it drops below the lower Bollinger Band, then you buy in. If it touches the upper Bollinger Band, then you just cash out. And on top of that, we are using the ADX as an add-on to determine the strength of the trend. So you'll see, so over here, we are same thing. We're initializing the start date, setting the initial cash position to be 100K. And we are testing on in this case, we're just testing on the SPY. And then the Bollinger Bands is basically, we're just initializing the indicator. And then over here, we're just also initializing the ADX indicator with a daily resolution. And the warm-up period is 20 days. And this is where the strategy is. So this is basically the same thing. We're getting the price of the securities on a daily basis. And basically, if self, not portfolio, not investor, right? So we're starting from here. and basically there's nothing in our portfolio, and the price of the stock is actually below the lower Bollinger Band, which is this part, and the negative directional index is more than or equals to 25. That means the negative trend downwards is actually pretty strong. Then we actually buy into the stock. And conversely, if we actually have equities in our portfolio, and if the price is reaches the upper Bollinger Band, like what I described just now, like and the negative directional index is smaller than 25, then we actually liquidate the portfolio. It means that basically just indicating a bullish sort of reversal sign. So this part is basically the same, just updating the benchmark value in accordance to the SPY. So our backtesting. Yeah, so as you guys can see, this strategy actually is done quite similarly to the SPY benchmark, but so the compounding annual return is actually 14.188%, which is actually I would say it has slightly beat the SPY. 14.18% over how many years? Over 8 years is actually pretty good. So if you look at like the average loss, it's negative 2.47%. If you look at the drawdown, the drawdown is actually pretty good. So so normally people will look at the Sharpe ratio. So usually the higher the Sharpe ratio, the better. And then you look at the CAGR, and then you look at your drawdown as well. So this strategy is a lower risk strategy, and with lower risk, it's like lower returns. So it really depends on sort of your investment sort of strategy or your directive that you have for yourself. Are you sort of willing to take on more risk, which usually comes with higher returns, although not always? Or are you more of a sort of a safer kind of person and you want to go for like a lower kind of Sharpe ratio or lower CAGR and a lower drawdown, but in return you get a more sort of a more consistent portfolio. So that's basically it for coming up with your own algorithms and then backtesting it. And just a few things to take note, or a few things you can try if you guys are interested. So basically this Quantconnect platform, I would highly recommend Quantconnect for equities. If you're into FX, you can use MP4. But it has, honestly, if you're not into like programming and whatnot, it's actually very hard because they have their own language, and it's not like it's honestly it's more complicated than slightly more complicated than Python. So they have their own language, but it's the most popular forex trading platform. Another one you can use is Quantopian. So yeah, so this is another one you can use. And oh, okay, I actually didn't know that it was shutting down. Basically, I think they're joining Robinhood. And yeah, so basically, I think we can scrap the Quantopian part. Last time I checked, it was still like operating. Basically, you just scrap the Quantopian part and just use Quantconnect if you're into equities. So basically, like if you guys are interested, when you have the free time, you just create a free account and then just go to this bootcamp thing. Then you just like press start. Then they just teach you like how to create a basic trading strategy. It's basically what I just gone through with you guys just now. Basically just set the equity, then set whatever symbol you want to use, maybe Apple or Microsoft or Amazon or whatever it is. You set equity, then you set a starting cash, and then you set your initial start date and whatnot. You just implement your strategy in this on data part. So this on data part, right, is basically this data, right? If you guys are confused, like what the heck is this, right? Basically, this data is just like the price data. Basically, just feeds in the data that you requested in terms of the resolution that you requested. So in this case, it's daily resolution. Right? So they will feed in data, daily price data. So it's usually the closing price of your particular instrument. In this case, it's Amazon. They'll feed in Amazon's sort of closing price for what for the time period that you have requested. And basically, everything you need to know is just got to be good at reading documentation. And basically they basically have everything lah. Right, so Quantconnect is basically like, I think like right now is like I would say is the #1 platform for equities that I see a lot of people using as well. So they're not just like basic boot camps, they're also like more advanced like strategies that they actually share with you guys, which you can try in your free time. And then the documentation is you guys the indicators is all over here. Like just now I showed you guys. I think there's easily close to 100 indicators here lah. So I mean, if you guys are interested, you can go and like matter around lah. Yeah, and with that, are there any questions? Okay. So okay, so there's someone who wants me to share the RSI strategy again. Yeah, so I will do that. So basically, this RSI strategy, this is a very simple strategy. So we set the start date to be 2012, 1st of January, and we set the initial cash to be 100K. And the ticker we are buying is, in this case, is TNA. So it's your 3 times small cap. 3 times small cap. And then the benchmark ticker is basically SPY. And over here, I'm just initializing the RSI indicator, which you can see over here. Where is it? Relative strength index. Yep, over here. So basically, we look at this relative strength index, right? It computes the relative strength index divided by K, blah 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 blah. And basically, these are all the various sort of methods under this RSI class. So how you initialize it is basically you call RSI, and then you just put in the respective arguments in the documentation, which is what I did just now. So self.rsi, because it's Python, you need to use the self, because it's just like convention, you need to refer to the class itself or the object itself that you're instantiating. So self.ticker, then the period is three period RSI, then the resolution is daily. And the on data is basically you're just filling in the data on a daily basis, which is what we requested. And then we first thing we're retrieving the price for that day itself, and then we are checking the price and we're using the RSI indicator as a sort of as a cue to buy into the stock or to sell out of the stock. So in this case, how you might be wondering how I got the value of 12, right, and 85, right, is by trial and error. So I guess and check. So I initially just put at 5, then I put at 90, then I just backtest many times, and I see which one gives the best results. And most of the time it's like that one. But I just play around the numbers and optimize it along the way. So that's basically it. That's basically the strategy. With the RSI, so once again, I think it'd be useful to reference the chart. So this is basically the 3-period RSI. Look at so the length is 3-period RSI, and it's basically the smooth RSI with the least squares method. I think the page is lagging a bit right now. But basically, like what I showed you guys just now, so if the RSI is a lower value, it generally means that the stock is oversold. So that would be a good time. It means that it's a good time to buy into the stock. And conversely, if it's above, it's very high, means that it's probably overbought, which would mean that it's a good time to get out of the stock. And then if possible, take your profits. So this strategy basically is it generally beats the markets on most days. So I would say it's a good strategy overall. Yep, and why are the values 8, 21, 34, 55, and 81 commonly used? Okay. I think you'll be very disappointed in my answer. So I've actually went to search this up before, but it's really conventional. Like it's really like there's really so I to the person who posted this, right? I really have no clear answer to this. I mean, you can try other value, but the consensus is that most people in the industry, they use these values because it gives like sort of a good sort of estimate of like the various price changes across the different time periods. So it's not too close, yet not too far from each other to provide sort of a meaningful difference between the different time periods. So this is like as like sort of the best way that I can explain it. So basically, like I think just now I go through I explain to you guys what like stacked EMAs means, right? So basically, stacked EMAs is when sorry. Basically, you look at all these colored lines, right? The stacked EMAs is when the 8-day, in this case, right? Let's say a positive bullish stacked EMA, right? Which is a very positive bullish sign. Is when an 8 is bigger than a 21, which is bigger than a 34, which is bigger than a 35, and it's also bigger, and the 55 is bigger than a 81. So that's a bullish, sort of a very bullish sign. So in this case, if you look at the so in this case, I plotted the 8 EMA as red, and then the 21 is basically just the middle line, and 34 is green, then 55 is fuchsia, and then 89 is yellow. Yeah, so basically, like when it depends on how you want to plot it, but basically when like all the lines are stacked up, and in this case, I don't know whether you guys can see it, but basically in this case it's pretty stacked. The red is above the yellow, which is above the green, which is above the fuchsia, the purple one, which is above the gray. So this is a very bullish sign. So whenever this happens, and maybe say your stock goes below like so maybe the -2 Bollinger Band or something like that, then you can actually consider going because it's a very strong trend. So yeah, so back to the question, it's really conventional, and that sort of the commonly agreed like time period that people think it provides just a middle ground for meaningful difference between different comparisons. So how do you plug your trading algorithm into a brokerage platform? Unfortunately, I don't know of any. I assume when you mean plug your trading algorithm, it means that you say, like, I'm assuming you mean like from like this kind of Python thing into like maybe Quantconnect or something like that, right? The answer is there's no real way you can actually do that, because most trading platforms like Quantconnect and MT4, they have their own trading, they have their own like API, and they have their own sort of language. So you have to have to use their language, and you have to learn it. You have to learn you have to go to documentation and learn everything. So that is unfortunate. There'll be a bit of a learning curve, unfortunately. And back to the question, and basically, how do you plug your so basically that's it. You can I would say you cannot plug your trading algorithm into a brokerage platform. And if on a side note, right? If you meant like how do you codify? Yeah. Most really have indicators built in, so it's easier. It makes it even easier, lah. Like I mentioned earlier, the hard part is definitely the starting part, where there's a huge learning curve, especially if you are new to programming, when you have to learn like the how to use the API properly, and then you'll run into like a lot of compilation errors. So it'd be good if you can have someone to help you along, or can find people to sort of help you along. That's basically it. And if you're asking like whether or not sort of how do you actually codify your trading ideas into algorithms, that one is I can't exactly teach you lah. That one is really like you need to go and learn it yourself. There's a general template that you can use, which I believe I put in my slides. So basically, you come up with a big picture idea for creating an algorithm. Come up with the idea. For example, wanting to buy when the RSI is low and when the price is below the lower Bollinger Band, and then you eyeball the chart. So the first step is always to come up with a big picture idea. So you never start out with the code first. Come up with a big picture idea. You see whether it's practical. See whether it works in the past on a particular stock you're looking at, and then after that you codify it into the algorithm, usually in the Quantconnect platform or some other platform that you use them. And you come up with hard numbers, like maybe say the RSI is 15, then you go in, or maybe the lower Bollinger Band -3 SD, then you go in, or something like that. So these are your hard numbers. And then you backtest the strategy by running it on historical data, preferably for at least 5 years. And then lastly, you keep backtesting it to optimize the hard numbers, which is basically your stop loss, your maximum drawdown, your indicator threshold values, and then you get your optimized algorithm. So that's basically it. That's how you would codify your algorithm. Yeah, so the Quantconnect platform is just Python OOP actually. If you know Java or C#, you can also use it. Most people use Python now. Yeah. So you can see here, right? Most of them. So Quantconnect uses either C# or Python. So it's up to you guys. I prefer to use Python because it's honestly what most people use. So if you use C#, you'll be sort of an outlier, and then it's not very good for troubleshooting and whatnot. Okay, anyone has any more questions? Okay, if not, right, yeah, I think I've come to the end of my presentation. And before that, I just wanted to sort of promote this hack for good kind of thing. So if you guys are interested in hackathon or whatever, you want to join with your friends, just have some fun. The sign-ups is go to this link, or you can scan the QR code. And I'll give you guys some time to scan if you're interested. Okay, yeah. So I think, so one more thing before I end today's workshop. I'll need you guys to turn on your cameras. We want to take a group photo. Yep. So you just help me turn on all your cameras.
Yep. Okay. It's done.
Okay, so with that, I think we'll come to the end of the workshop. Yeah, thank you everyone for coming today. I hope you guys if you guys are interested, you can just go to Quantconnect platform. You can drop us an email if you're interested in learning more. Yeah, thank you guys.